All right, so you ready to dive into the Indian stock market?
Let's do it.
This should be really interesting. You've given us a snapshot from Google Finance
Okay.
and a guide to sector analysis and stock picking.
Sound good.
So it looks like we're going to help you figure out how these exchanges work,
Right.
how to analyze those sectors, and ultimately how to pick those winning stocks.
It's funny you should mention Google Finance. It really highlights how intertwined technology and finance have become, wouldn't you say?
Absolutely. Even Google, a company known for search engines and self-driving cars, recognizes the importance of the financial world. It's a good reminder that understanding finance is relevant for everyone, not just Wall Street gurus.
Exactly.
Oh.
And that's where the BSE and NSE come in. They're the two major players in the Indian stock market. Think of them as bustling marketplaces, where companies list their shares to be bought and sold. The BSE. The Bombay Stock Exchange is the older of the two, established way back in 1875.
Wow, 1875. That's a long history. What
Yeah.
about the NSE?
The NSE, or National Stock Exchange, came on the scene much later in 1992, but it quickly gained traction, known for its modern technology and efficient trading platform.
So BSE is the seasoned veteran and NSE is the tech-savvy newcomer. But before we even think about buying stocks, your sources emphasize the importance of sector analysis. I'm curious, why is understanding sectors so crucial when it comes to investing?
It boils down to three key reasons. First, sector analysis helps you identify growth opportunities. Different sectors go through cycles of growth and decline, depending on economic conditions and global trends. Remember the surge in e-commerce during the pandemic? That's a prime example of a sector capitalizing on a major shift in consumer behavior.
I see. So understanding sector trends can give you an edge in finding those potential winners, right? What are the other reasons?
Absolutely. The second reason is all about managing risk. Diversifying your investments across different sectors helps to cushion the blow if one sector underperforms. It's like the old saying, don't put all your eggs in one basket.
That makes sense. Spreading your bets can help smooth out the ride, especially in a volatile market. And the third reason,
Sector analysis also provides a window into the overall health of the economy. For instance, a strong performance in the banking sector often suggests a healthy economy, while weakness in the manufacturing sector might signal a slowdown.
so it's like getting a pulse check on the economy by observing how different sectors are performing. That's fascinating. Now let's get practical. How do we actually go about analyzing a sector? I imagine it involves a lot of data and research.
You're right, it does involve research, but it's not as daunting as it might seem. We can break it down into three manageable steps. First, you start by analyzing broad economic indicators like GDP growth, inflation, and interest rates. These can give you clues about which sectors are likely to benefit or face headwinds in the current economic environment.
Okay, so start with the big picture. Then what?
Next, you zoom in and look at sector-specific indices. These indices track the performance of a particular sector, like the Nifty Bank Index for banking stocks, or the Nifty IT Index for technology companies. By comparing these indices to the broader market index, you can see which sectors are outperforming or underperforming.
So it's like comparing a specialized team of athletes to the overall league standings. You get a better sense of their strengths and weaknesses within their specific area of expertise. And what's the final step?
The last step is to delve deeper into individual companies within a sector. This is where you'll use key financial metrics like the price-to-earnings ratio, PE ratio, return on equity, ROE, and debt-to-equity ratio to compare companies and identify potential winners.
Okay, now we're getting to the nitty-gritty. Can you explain what those metrics actually tell us about a company and its potential? And how can we use this information to compare companies within a sector?
Absolutely. Let's start with ROE, or return on equity. This metric tells us how effectively a company is using its shareholders' money to generate profits. The higher the ROE, the better a company is at converting its investments into earnings.
So if a company has a high ROE, does that automatically make it a good investment, or are there other factors to consider? And what about this PE ratio? I hear that thrown around a lot.
That's a great question. While a high ROE is generally a positive sign, it's not the only factor to consider. It's important to understand the context. For instance, your source mentions Tata Motors. They have a high ROE of around 18%, which suggests they're using their equity effectively.
That's impressive. But is there a potential downside to a very high ROE? I'm curious to know what else we should be looking out for.
You're thinking like a true investor. Sometimes a very high ROE might indicate that a company is taking on excessive risk or leveraging itself heavily with debt to boost returns. That's where the debt-to-equity ratio comes in.
Okay, so the debt-to-equity ratio tells us how much debt a company is using compared to its equity. What's a healthy range for this ratio, and how does it factor into our analysis?
Generally, a lower debt-to-equity ratio is considered more favorable. It indicates that a company is relying more on its own funds rather than borrowed money to finance its operations. The source highlights Hindustan Unilever, a company with a very low debt-to-equity ratio of 0.5 compared to its peers, who are closer to 1.2.
So in this case, Hindustan Unilever's low debt-to-equity ratio suggests that they're financially stable and less vulnerable to economic downturns. That's definitely a good sign for investors.
You're catching on quickly. Remember, it's all about understanding these metrics in relation to each other and considering the specific circumstances of the company and the sector it operates in.
This is incredibly helpful. I'm starting to see how these metrics can paint a more detailed picture of a company's financial health and help us make more informed decisions. But we've been focusing on individual company metrics. What about broader factors that can impact a sector's performance?
That's a crucial point. External factors like global trends, government regulations, and technological advancements play a huge role in shaping a sector's trajectory.
Can you give us some examples of these external forces at play in the Indian market? I'm eager to understand how these bigger trends can translate into investment opportunities.
Of course. Take the renewable energy sector, for instance. Your source highlights companies like Adani Green and Tata Power, which are benefiting from the global push towards sustainability and India's ambitious renewable energy targets.
That's a great example. It seems like identifying those emerging trends and understanding their potential impact on different sectors is crucial for making smart investment choices.
Precisely. It's about connecting those global and local trends to specific companies and sectors within the Indian stock market.
This has been a fantastic overview of sector analysis. I feel like I've gained a solid foundation for understanding how to evaluate different sectors and identify potential investment opportunities. But now I'm curious, how do we take this knowledge and apply it to the actual process of picking individual stocks?
That's an excellent question, and it leads us to the next stage of our deep dive, the art and science of stock picking. We'll explore different approaches from fundamental analysis to technical analysis and see how they can help us narrow down our choices and make those winning selections.
All right, I'm ready to dive into the world of stock picking. Let's uncover those strategies and see how we can put our sector analysis skills to the test. So we've laid the groundwork with sector analysis. Now I'm ready to get into the nitty-gritty of picking individual stocks. Where do we even begin?
It's like assembling a puzzle, right? We've got the big picture from our sector analysis. Now we need to find those individual pieces that fit together to create a winning portfolio.
I like that analogy. So what are the tools we can use to find those perfect puzzle pieces?
Well, there are a few key approaches to stock picking, each with its own set of techniques and insights. First up, we have fundamental analysis. This is all about digging deep into a company's financial statements, their balance sheets, income statements, cash flow statements. It's like looking under the hood to see what's really driving the engine.
Sounds like we're going to need our detective hats for this one. What kind of clues are we looking for in those financial statements?
We're trying to determine the intrinsic value of company. Essentially, what is it truly worth? We look at metrics like earnings per share, price-to-book ratio, debt levels, and profitability margins to assess its financial health and growth potential.
So fundamental analysis helps us separate the companies with solid foundations from those built on shaky ground. What other approaches can we use?
Next, we have technical analysis. This is a completely different approach. It focuses on studying historical price charts and trading patterns to identify trends and predict future price movements.
So instead of looking at the company's financials, we're looking at how its stock has behaved in the market, almost like reading tea leaves, but with charts and graphs.
Exactly. Technical analysts use tools like moving averages, support and resistance levels, and momentum indicators to try and anticipate where the stock price is headed. It's a more speculative approach, but many traders find it valuable in timing their entry and exit points.
It's fascinating how there are such contrasting approaches to stock picking. One focused on the company's fundamentals, the other on market trends. What are the other methods?
We also have quantitative analysis, which involves using statistical models and algorithms to identify potential investment opportunities. This approach relies heavily on data analysis and computer programming, often used by hedge funds and institutional investors.
That sounds pretty sophisticated. Definitely not for the faint of heart.
It can be quite complex.
Yeah.
But it's become increasingly popular as technology advances and data becomes more readily available.
And what about the less quantifiable aspects of a company? Things like leadership, brand reputation, and competitive landscape. How do those factor into our stock picking decisions?
That's where qualitative analysis comes in. It considers those intangible factors that can impact a company's long-term success. Things like the quality of its management team, the strength of its brand, and its competitive position in the market.
So it's about looking beyond the numbers and assessing the company's overall story, its strengths, weaknesses, and its potential for future growth.
Exactly. Qualitative analysis helps us understand the bigger picture, the company's culture, its strategic vision, and its ability to adapt to changing market dynamics.
This all makes sense in theory, but can we see how these different approaches work in practice? Maybe a real-world example to bring it all together?
Yeah, your source actually provides a great case study, HDFC Bank. It's considered a blue-chip stock in the Indian market, and we can use it to illustrate how those different stock-picking methods can be applied.
All right, let's break down HDFC Bank and see what makes it tick.
From a fundamental analysis perspective, HDFC Bank has consistently strong financials, a high return on equity, low debt levels, and a wide network of branches across India.
So the fundamentals look solid. What about from a technical analysis perspective?
Technically, the stock has been in an uptrend for the past few years, with strong support levels and positive momentum indicators.
That's encouraging. What insights can we gather from a quantitative perspective?
Quantitative models often highlight HDFC Bank's low volatility and consistent earnings growth, suggesting it's a relatively stable and predictable investment.
And what about the qualitative factors? What makes HDFC Bank stand out in the banking sector?
Well, HDFC Bank is known for its strong management team, its focus on customer service, and its early adoption of digital technologies. These factors have contributed to its reputation as a reliable and innovative bank.
Wow, it sounds like HDFC Bank checks a lot of boxes across all four approaches: strong fundamentals, positive technicals, favorable quantitative signals, and a solid qualitative story. It's no wonder it's considered a blue-chip stock.
It's a great example of how these different methods can complement each other, providing a comprehensive view of a company's investment potential.
This case study has been really helpful in seeing how the puzzle pieces fit together. But I'm also realizing that stock picking is not just about analyzing companies. It's also about understanding ourselves as investors, our risk tolerance, our investment goals, and our time horizon.
You're absolutely right. There's no one-size-fits-all approach to stock picking. It's about finding the methods and strategies that align with your individual investment philosophy.
This has been an incredibly insightful exploration of stock picking approaches, but I'm curious, are there specific metrics we should pay close attention to when evaluating individual stocks? Something like a cheat sheet of key indicators.
Absolutely. There are a few key metrics that can provide valuable insights into a company's performance and potential metrics that can help us separate the wheat from the chaff, so to speak.
Okay, let's dive into those key metrics. Give me that cheat sheet, okay? Let's dive into those key metrics. Give me that cheat sheet.
One of the most important metrics is earnings per share, or EPS for short. It tells us how much profit a company is making for each share of its stock. A higher EPS generally indicates stronger profitability.
So if a company has an EPS of 10 rupees,
Yeah.
it means that for every share of stock you own,
Right.
the company earned 10 rupees in profit.
Precisely. Your source compares the EPS of two IT companies, TCS and Wipro. TCS has an EPS of 100 rupees, while Wipro's EPS is 60 rupees. This suggests that TCS has generated more profit per share, which could make it a more attractive investment.
That's a clear example of how EPS can help us compare companies within the same sector. What other metrics should we be looking at?
Another important metric is the price-to-book ratio, or PB ratio. It compares a company's stock price to its book value per share, which represents the net worth of the company's assets.
So a low PB ratio means the stock is trading at a discount to its book value. That sounds like a good deal, right?
Not necessarily. A low PB ratio could be a sign that the market is undervaluing the company, but it could also be a red flag,
Oh.
indicating potential problems with the company's assets or its future prospects.
So it's like anything else in life. If it seems too good to be true, it probably is.
Exactly. It's essential to investigate why a company has a low PB ratio. Don't just assume it's a bargain.
Okay. What other metrics should we have on our radar?
Dividend yield is another metric that's important for income-focused investors. It measures the annual dividend payments relative to the stock price. A high dividend yield can be tempting, but it's crucial to assess its sustainability.
How can we tell if those high dividends are sustainable?
Your source uses Coal India as an example. It has a dividend yield of around 7%, which seems attractive. But the long-term prospects of the coal industry are uncertain due to environmental concerns and the shift towards renewable energy. This raises concerns about whether Coal India can maintain those high dividend payments in the future.
So a high dividend yield is only good if the company has a solid business model and a sustainable future. What about cash flow? I've heard that's a crucial indicator of financial health.
Absolutely. Free cash flow is the cash a company is left over after paying for its operating expenses and capital expenditures. It represents the cash available to reinvest in the business, pay dividends, or buy back shares.
So strong free cash flow gives a company more financial flexibility and options. That sounds positive.
It is. Companies with strong free cash flow like Reliance Industries are often viewed favorably by investors as it indicates their ability to generate cash and fund future growth.
This metric cheat sheet is incredibly helpful. I'm starting to feel like I can actually decipher those financial reports and make informed decisions. But I know there's always more to learn in the world of investing. What other factors should we be aware of?
One crucial aspect we haven't discussed yet is the impact of market sentiment and investor psychology.
That sounds intriguing. How do emotions play a role in stock picking?
The stock market is not always rational. Investor sentiment, fear, greed, speculation can significantly impact stock prices, sometimes driving them above or below their intrinsic value.
So it's not just about numbers and metrics, it's also about understanding the human element of the market, the psychology behind those buying and selling decisions.
Precisely. Learning to read market sentiment and recognizing those periods of irrational exuberance or extreme fear can be a valuable skill for any investor.
This adds a whole new layer of complexity, but also excitement to the world of stock picking. It's like a giant game of chess where we need to anticipate the moves of other players and navigate those psychological currents.
You're catching on quickly. The stock market is a dynamic and ever-evolving ecosystem, and understanding the interplay of fundamentals, technicals, quantitative analysis, qualitative factors, and market psychology is crucial for making informed decisions.
This has been an incredible journey so far, from understanding the basics of the BSE and NSE to analyzing sectors to mastering different stock picking approaches. I'm feeling more confident and equipped to tackle the Indian stock market. But before we wrap up, I'm curious, what are some of the current trends and developments shaping the Indian stock market? What should investors be paying attention to right now?
That's a great question, and it leads us to the final chapter of our deep dive, exploring the ever-changing landscape of the Indian stock market and identifying those emerging trends that could shape the investment landscape in the years to come.
Okay, let's dive into those trends and see what the future holds for the Indian stock market.
The Indian stock market is in a constant state of evolution. One of the most prominent trends is the rise of new age sectors like renewable energy, electric vehicles, and artificial intelligence. These sectors are attracting significant investor interest, driven by government initiatives, technological advancements, and shifting consumer preferences.
It's fascinating to see how these global trends are playing out in the Indian market. We already talked about Adani Green and Tata Power in the renewable energy space. Are there other companies in these emerging sectors that are worth watching?
Absolutely. In the electric vehicle space, companies like Tata Motors and Mahindra are making significant strides. They're investing heavily in EV technology and expanding their product portfolios to cater to the growing demand for electric cars and two-wheelers.
It seems like the electric vehicle revolution is truly gaining momentum in India. What about artificial intelligence? How is that trend shaping the investment landscape?
AI is transforming industries across the board, from healthcare to finance to retail. Companies like Infosys and TCS are at the forefront of AI innovation, developing cutting-edge solutions for businesses worldwide. They're also investing heavily in AI talent and research, positioning themselves as leaders in this rapidly evolving field.
So these tech-driven sectors definitely seem like areas to watch for investors seeking growth opportunities. But what about the broader economic picture? How are global factors impacting the Indian stock market?
Global factors play a significant role. Rising oil prices, for example, can impact energy companies and sectors that rely heavily on transportation costs. Similarly, supply chain disruptions can create challenges for manufacturing and retail companies. Geopolitical tensions can also create volatility and uncertainty in the market.
It's a reminder that the Indian stock market is not isolated from global events. It's interconnected with the world economy, and investors need to be aware of those global dynamics. What about the impact of government policies? We touched on this earlier.
Government policies can have a profound impact on specific sectors and the overall market sentiment. For example, the Make in India initiative and production-linked incentive (PLI) schemes are designed to boost domestic manufacturing and attract foreign investment. These policies can create tailwinds for certain industries and spur economic growth.
So keeping abreast of government policies and regulations is crucial for investors. It's like understanding the rules of the game before making any moves. What other advice would you give to investors navigating the Indian stock market?
One of the most important pieces of advice is to do your own research and due diligence before investing in any stock. Don't rely solely on tips or recommendations. Understand the company's business model, its financials, its management team, and its competitive landscape.
It's about taking ownership of your investment decisions and not blindly following the crowd. Knowledge is power, especially in the world of investing. What about managing risk? Any tips for investors, especially those who might be new to the market?
Diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors, companies, and asset classes to mitigate risk. And remember, investing is a long-term game. Don't get swayed by short-term market fluctuations. Stay focused on your investment goals and have a disciplined approach.
Those are incredibly valuable insights. So as we wrap up this deep dive into the Indian stock market, I'm curious, is there a final thought-provoking question that we can leave our listeners with something to ponder as they continue their investment journey?
Here's a question to consider. We focused on the Indian stock market, but do you think these same principles of sector analysis, stock picking strategies, and understanding market dynamics apply to other stock markets around the world?
That's a fantastic question. It challenges us to think beyond geographical boundaries and consider the universal principles of investing. As we've learned, while the specifics might vary, those core concepts of evaluating companies, understanding trends, and managing risk are relevant no matter where you choose to invest.
Exactly. The world of investing is interconnected, and the lessons we've explored today can be applied to markets across the globe. The key is to stay curious, keep learning, and adapt those principles to the unique characteristics of each market.
This deep dive has been an incredible journey of discovery. We've gone from deciphering the basics of the BSE and NSE to dissecting financial statements and understanding the nuances of different stock-picking approaches. I feel like we've equipped our listeners with the tools and knowledge they need to confidently navigate the Indian stock market.
It's been a pleasure sharing this journey with you. I hope our listeners feel empowered to continue exploring the world of investing and making informed decisions that align with their financial goals.
And to all our listeners out there, remember that investing is a continuous learning process. Stay engaged, stay curious, and never stop seeking knowledge. Until next time, happy investing.